Hi everyone, welcome back to Chapter 9. In the previous Chapter 9 video lectures, we covered short-term notes payable and payroll liabilities. In this video, we'll take a look at estimated liabilities, contingent liabilities, and tie up some loose ends to finish up Chapter 9. Let's start with accounting for estimated liabilities. An estimated liability is a known obligation that is of an uncertain amount, but can be reasonably estimated. Common examples are employee benefits such as pensions, health care, and vacation pay, and also warranties offered by a seller. We'll discuss these in the next few slides. Health and pension benefits. Many companies provide employee benefits. An employer often pays all or part of medical, dental, life, and disability insurance. Many employers also contribute to pension plans, which are agreements by employers to provide benefits or payments to employees after retirement. Many companies also provide medical care and insurance benefits to their retirees. To illustrate, assume an employer agrees to pay an amount for medical insurance equal to $8,000 and to contribute an additional 10% of the employee's $120,000 gross salary to a retirement program. Let's do the calculations. All of the employees together earned $120,000. Multiply that times 10%. That equals $12,000 contribution to the retirement program, plus $8,000 contribution to the medical insurance. That equals a total expense of $20,000 for this period. Debit employee benefit expense of $20,000. Credit employee medical insurance payable, $8,000. And credit employee retirement program payable, $12,000. Many employers offer paid vacation benefits, also called paid absences. Vacation benefits are estimated and expensed in the period when the employees earn those benefits. For example, assume an employee whose gross salary is $1,600 per week earns 2 weeks of paid vacation each year. We're going to assume that it's a 5-day week, so 2 weeks equals 10 days of vacation. And we're also going to assume that the days are 8-hour days. So the 2 weeks of vacation is the same as 10 days vacation, which is the same as 80 hours of paid vacation. So it's 2 weeks. The salary is $1,600 per week. Multiply that times the 2 weeks. And you debit vacation benefits expense, $3,200, and credit vacation benefits payable, $3,200. Then in the following time period, when an employee takes 10 hours of vacation, the following journal entry would be recorded. Let's do the math first. $3,200 of vacation benefits payable divided by 80 hours equals $40 per hour. $40 times the 10 hours of vacation the employee took equals $400 of the vacation benefit used. Debit vacation benefits payable, $400. Credit cash, $400. Let's talk about bonus plans. Assume that a bonus of $10,000 will be paid to employees to be shared by all employees. Well, at the end of the year, we're going to need to accrue the bonus. Debit employee bonus expense, $10,000. Credit bonus payable, $10,000. Let's talk about warranties. A warranty is a seller's obligation to replace or fix a product that fails to perform as expected within a specified period. Most new cars, for instance, are sold with a warranty covering parts for a specific period of time. The seller reports the expected warranty expense in the period when the revenue from the sale of the product is reported. The seller reports this warranty as a liability, even though the amount, the payee, and the date of the future payments are completely uncertain. But we're going to record the liability expense anyway because such warranty costs are probable and the amount can be estimated. We could estimate, for instance, using the past experience with warranties. For instance, on December 1st, 2019, a dealer sells a car for $16,000 with a maximum 1 year or 12,000-mile warranty covering parts. Past experience indicates warranty expenses average 4% of a car's selling price. Let's do the math. $16,000 selling price times 4% equals an estimated warranty expense of $640. In December, when the car is sold, we're going to debit warranty expense, $640, and credit estimated warranty liability, $640. Then in the next time period, say on January 9th, 2020, the customer returns the car for repairs. The dealer replaces parts costing $200. Debit estimated warranty liability, $200, and credit auto parts inventory, $200. Now let's switch gears and talk about contingent liabilities. A contingent liability is a potential obligation that depends on a future event arising from a past transaction or event. An example is a pending lawsuit. Here, a past transaction or event leads to a lawsuit whose results depend on the future outcome of the lawsuit. Future payment of a contingent liability depends on whether an uncertain future event will occur. Accounting for contingent liabilities depends on the likelihood that the future event will occur and also depends on whether it's possible to estimate the future amount owed if this event does occur. So the likelihood that the future event will occur is either probable, just possible, or a remote likelihood that the event will occur. We can either estimate the amount that will be owed if the event occurs, or it is simply not estimable. There's just not enough information to be able to estimate the liability. So let's take a look at how this works. If the future event is probable, it's pretty darn sure that this event will happen, and we can estimate the amount, then we need to book or record the liability in the books and disclose it in the footnotes as well. If the future event is probable, but we simply do not have enough information to make an estimate of how much will be paid, then we simply can't book the liability. You can't estimate a number, so you can't debit or credit anything. But you must make full disclosure in the notes to the financial statements. Let's say the future event is only possible. It's possible that this is going to happen, but not for sure. Then don't try to book the liability, but do make full disclosure in the footnotes to the financial statements. And let's say the future event is remote. It's just very unlikely that the event will happen. It's very unlikely that we might lose the lawsuit, for instance. Then you do not have to worry about booking a liability or even making disclosure in the footnotes. There's a ratio on page 384 of your textbook, and it's times interest earned ratio that can be used to analyze liabilities. The ratio is calculated as income before interest and income taxes divided by interest expense. And the theory behind this ratio is that if income before interest and taxes varies greatly from year to year, then fixed interest charges can increase the risk that an owner will not earn a positive return and will be unable to pay the liability and the interest owed on that liability. A benchmark that you can use is if times interest earned falls below 1.5, a company will be likely to be risky for default on the liability. Here's an example. Diego Company. This is their income statement for 2019. Net income is $90. Interest expense was deducted to arrive at the $90 of net income, and that was $60. There is nothing here for income tax expense. The formula we're trying to calculate is income before interest expense and income taxes divided by interest expense. So $90 of net income, add back interest expense of $60 plus 0 income tax expense equals $150. So the numerator in our calculation of income before interest expense and income taxes is 90 plus 60 plus 0 income tax expense equals 150. Divide that by your interest expense of $60, and it's 2.5 times. This ratio means that Diego has low to moderate risk because its sales must decline sharply before it is unable to pay its interest expense. As stated in the last slide, if times interest earned falls below 1.5, a company will be likely to be at risk for not paying their liabilities. Well, Diego's times interest earned is significantly above 1.5, so they are not a high risk. Well, that's all for Chapter 9. See you next time.